Hello students, welcome back to our Accounting 0452 MCQ discussion series for the February-March 2025 examination. So far we have already completed question number 1 to 9 out of the 35. In today's session we will continue with the questions 10 to 20. I will be explaining each question in detail to help you understand the concept clearly and prepare confidently for your exam. Let's get started. Yeah, question number 10. Arnold's drop profit for the year was 17,000. His actual correct profit was 17,400. Which error had been made? Option A, purchases invoices for 2,600 had been recorded in the purchase journal as 2,200. And option B, sales invoices for 2,600 had been recorded in the sales journal as 2,200. And option C, discount allowed of $400 had been posted to the credit side of the discount allowed account. And option D, discount received of $400 had been posted to the debit side of the discount received account. Okay, let's analyze this question. So Arnold drop profit is 17,000. So yeah, drop profit 17,000, actual profit is 17,400. So the differences is 400, profit should be higher. So there must be an error that understated profit by 400. So let's see each option. Here, first one, purchase invoice for 2,600 had been recorded in the purchase journal 2,200. So purchase understated by $400. So expenses, purchases is trading expenses. No, it's understated. So what is the effect? Profit will be overstated by 400. So it's wrong. Then sales, second is sales invoice, right? Sales understated by 400. You can see sales invoice for 2,600 had been recorded in the sales journal as 2,200. Sales is income actually. Okay, revenue understated time, obviously profit will understated by 400. So this will be the correct answer. Let's see the option C. If wrongly credited, that means discount allowed of $400 had been posted to the credit side of the discount allowed account. So if wrongly credited, expenses is reducing, profit overstating with the 800. So because double effect. So this also incorrect. Then fourth, discount received of $400 had been posted to the debit side of the discount received account. So if wrongly debited, income is reduced by 800. So profit would be understated by 800. So the answer is B. Sales invoice for 2,600 had been recorded in the sales journal as 2,200. This is the right answer. Okay. So let's move to the question number 11. Paul calculated his profit for the year 40,000. Paul then discovered the following errors. The expenses includes rates prepaid $1,000 for the following year, 600 owed for electricity had been omitted, sales return 10,000 had not been recorded. What was the correct profit for the year? So this is drop profit, correct profit we have to find out. Okay, so I have already mentioned some important points to understand. Yeah, first error. The expenses included rates prepaid 1,000. So rates prepaid 1,000 were wrongly included in expenses for this year because prepaid following year means for next year amount you added here. So we have to remove the expenses. Okay, we have to remove the expenses. That time your profit will be increased by 1,000. So for the working year, 40,000 drop profit, you must add 1,000, so 41,000. Then 600 dollar owed for electricity had been omitted. Electricity owed 600 was omitted. So in expenses, that should be included. So including the expenses time profit obviously will decrease. Yeah, how much? 600. So 41,000, this amount minus 600. So now you got 40,400. Then third one, sales return of dollar 10,000 had not been recorded. Sales return, which balance? Sales return will be debit balance. Were not recorded, sales were overstated. So record the returns. So returns while recording, what will happen? Profit in decrease it by 10,000. Okay, because sales return. Okay, sales is income, sales return time will be, profit will decrease, no, decrease by 10,000. So for calculation new profit, 40,400 minus 10,000, so final answer will be 30,400. So answer B. Got it? Let's move to the question number 12. Yeah, the totals of Simon trial balance did not agree and he opened the suspense account. He then found that when he had restored the interest with $70, he had recorded it correctly in the petty cash book, but had recorded it in the wrong side of the main cash book. This was only the error they made. What was the opening entry in the suspense account? Okay, option A, 70 on the credit side. Option B, 70 on the debit side. Option C, 140 on the credit side. Option D, 140 on the debit side. Okay, let's carefully analyze this question. Okay, Simon restored the petty cash with 70. Okay, so what is the correct entry? Petty cash will be debited with the 70, cash credited with the 70. So here what happened? He recorded it correctly in the petty cash. That's what they said. No, recorded in the petty cash book is correctly. He recorded correctly in the petty cash, but in the main cash book he entered it on the wrong side. Wrong side. Okay. So instead of crediting cash $70, he debited cash $70. So cash was debited $70 instead of credited 70. So what is the total error? 70 plus 70, 140 is the difference. Okay. Therefore, the suspense account at the balance of $140. So cash is debit balance, right? While doing trial balance, the differences will come credit side, right? So the suspense account entry 140 on the credit side. So answer is C, this one. Okay. Yeah, let's move to the question number 13. Jamal's statement at 1st May showed a bank overdraft of 1460. At the date, there were unpresented checks of $385 and uncredited deposit of $255. What was the cash book balance at 1st May? So this is completely related to bank reconciliation statement. Remember, in the cash book, credit side balance we will call bank overdraft 1460. Here we have to use the format. Okay, bank reconciliation statement balance as per bank statement is this 1460. That means negative balance. Overdraft means negative balance minus 1460. Then uncredited deposits, please remember, uncredited deposits we have to add it. So 255 we have to add plus it. Then you will get the answer negative 1205. Okay, then unpresented check you have to minus it. So 385. You will get the correct figure now. Balance as per cash book 1st May is again negative figure 1590. So cash book balance is showing negative figure means it's credited. 1590 is credited. Got it? So let's move to the question number 14. Yeah. Which items included in the sales ledger control account? Okay. So I used to tell all my students, please learn the control account format. That means sales ledger and purchase ledger. In IGCSE, two or three questions from the control account. If you learn the format without any mistake, you will get full marks. Okay, let's see. Here, sales ledger control account. Here, I already given sales ledger format and purchase ledger format. Okay, let's see one by one because the question here, which item are included in the sales ledger control account? First one, goods written by credit supplier. So it should be purchase ledger. This one, purchase ledger. Dates that have been written up as irrecoverable. Yes, it's sales ledger irrecoverable dates. No, here. Goods sold for cash. We will not record where we are supposed to write goods sold for cash book. Then checks received from credit customer written by the bank is dishonored. You have seen this here, dishonored. Yes, we will take. So option 2 and 4, the answer is D. Okay. Next, we are moving to the question number 15. After preparing financial statement, John T discovered two errors had been made in his accounting records. Error 1, vehicle repairs cost 1500 had been debited to the vehicle account. Legal fees 2100 relating to the purchase of new premises had been included in the expenses. Ignoring the depreciation, what was the effect of these errors on John T's profit for the year? So while doing errors question, you have to aware of the income statement. Okay. So here what happened? Vehicle repairs is the expenses. Expenses 1500 had been debited to the vehicle account means vehicle account is non-current asset, right? So the expenses they recorded into the non-current asset account. So expenses you are not writing in the income statement, your profit will be overstated. 1500 is overstated. Okay. Then second, legal fees 2100. Legal fees, it's capital expenditure, right? So under non-current asset, we are supposed to write, yeah, purchase of new premises. This amount we will add. Had been included in the expenses. So that new premises amount, it's recorded in the expenses side. That means obviously your profit will decrease, understated by 2100. So what is the difference? 1500 minus 2100, what will be the effect of net profit? Net profit understated by 600. Got it? So you have to aware of income statement. The more profit while adding, your profit will go down. Clear? If removing the expenses time, profit will be overstated. Got it? Yeah. So let's move to the question number 16. Which item is a revenue receipts? Okay, before choosing the answer, you have to aware of what is revenue receipt, what is capital expenditure, what is revenue expenditure, what is revenue receipts. Okay, so here I have already given some of the important points to remember. What is capital expenditure? Capital expenditure is money spent on purchasing a non-current asset or improving or extending the existing non-current asset. Revenue expenditure, this is the money spent on running our business on a day-to-day basis. Okay. Then capital expenditure cost will appear as a non-current asset in the statement of financial position. Revenue expenditure will be in the income statement. Here, capital receipt. Okay. Students are making mistake capital receipts and revenue receipts. Okay. What is meaning of capital receipts? Capital receipts occurs when money is received other than from normal trading activities and recorded as a capital or liabilities in statement of financial position. Okay. Revenue receipts is revenue receipts money received from normal trading activities recorded in the income statement as a revenue. Okay. So here effects, some effects I want to explain this. If capital expenditure is treated as a revenue expenditure. Okay. So previous question, you know, Revenue expenditure treated as a capital expenditure was there. So this is important, okay, points you have to remember. If capital expenditure treated as a revenue, that time non-current asset will decrease, expenses increases, profit decreases, equity decreases. Okay, please remember this. Then, if revenue expenditure treated as a capital expenditure, non-current asset will increase, expenses will decrease, profit will be increase, equity will be increases. Okay, please you have to aware of this. Let's see. Cash invested by the owner of the business. Is it revenue receipt? No. Proceeds from sale of non-current asset at book value. No. Rent received from letting part of the premises. Yes. Yeah. Revenue receipt is money received from normal trading activities. Okay. Then short-term loan received from a finance company. No. So answer is C. 17th one. Yes. This is the depreciation question. Little tricky one. Okay. So I will explain step by step. Then you will understand. Samuel started business on 1st January 2023 and bought two delivery vans for 12,000 each. He depreciates all the vehicles at the rate of 10% per annum, calculated monthly using the straight line method. On 1st April 2024, he sold one of the vans and replaced it with the larger one costing $24,000. What was the balance of the provision for depreciation of delivery vehicle account on 31st December 24? So here option A 3,300, option B 4,200, 5,700, 6,600 they given. Okay, how we are going to do this? So I already made on workings. We have to do the provision for depreciation account to find out actual depreciation. I want to explain. This is the basic steps. Okay. If you know this step, then everything will be easy for you. Now, beginning date. Step one is date. So this question starting, you can see here, 1st January 2023. So starting will be 23 and closing date 31st December 2023. Okay, so closing December, this is the opening date. Then step two, which method they're following? You can see straight line method is 10%. So please record it. Then very important, disposal date and assets. Which vehicle, which van they're going to sell. So 1st April 24 is sold one of the vehicle vans. One of the vehicle in these two delivery vehicle, one is going to sell. Okay. So disposal date and asset 1st April vehicle 1. Then step 3, depreciation we have to calculate. Okay, so first vehicle 12,000. I already told you the percentage is 10. 12,000 10% is 1,200. So there are two vehicles, right? Vehicle second 12,000 10%, 1,200, totally 2,400. So this 2,400 you have to record in the provision for depreciation account. Here balance brought down 2,400. Got it? Then after that step, how many year or month or days that asset was in your business. That means they're going to sell one, right? Here. 1st April 24, he sold one of the vans. That depreciation we have to calculate. How we are going to calculate? See here, 12,000, 10%. Then how many days in your, how many month, right? How many year, how many months altogether? So 15 months. How we will come to know 15 months? Because they purchased 1st January 2023 to 31st December 23 is 12 months. Then they're selling on 1st April. So January, February, March. Yeah, January, February, 3 months. Year 12 and year 3 months. Totally 15 months. So 1,500 depreciation for the disposal vehicle. Okay. So that amount you have to record here. For that we have journal entry, right? Yeah, disposals of vehicle 1,500 you have to record. First one, balance brought down you have to find. Then disposal of vehicle you have to find. Okay. Then the last step, step 5, remaining vehicle depreciation we have to calculation. Which are the vehicles we have in the year 2024? 2024, first 3 months, that second the vehicle was there, no? The vehicle sold on when 1st April. So those 3 months you have to calculate the depreciation. 12,000 10%, 3 months 300. Then the vehicle second 12,000 times 10%. Okay, 10% this one, 10 percentage. Okay, 10 percentage is 1,200. Then from where we got 24,000? Yeah, he sold one of the vans and replaced it with a larger one costing 24,000. This 24,000 is there now. You have to give the depreciation. Not for full year because you purchased on April. April to December. April to December, how many months? 9 months. That depreciation you have to calculate. So 300, 1,200, 1,800, together 3,300. This is the total depreciation in the year 2024. So here, 31st 12, 2024, income statement account debit, provision for depreciation delivery vehicle account. So income statement together 3,300 you have to record in the income statement. Now which side is amount is more? Here. So 5,400, the differences will be 4,200. That is the answer for depreciation. It's a lengthy procedure, but you know, if you practice 2-3 questions, then you will understand the way how to do this. Got it? So let's move to the question number 18. Sorry. Uh, a carpenter a carpenter uses revaluation method of depreciation for the hand tools used in the business. All hand tools in use at the end of financial year, including those bought during the year, are revalued. New hand tools were purchased during the year, but no hand tools were disposed of. Which value of hand tools shown in the calculation of the depreciation for the year? See, we have three types of depreciation, right? Straight line method, revaluation method, and reducing balance method. So for each one we have formula, right? So revaluation method formula is value at the beginning plus any purchases less value at the end. Okay. Here option A, value at the start less cost of new tools. This is incorrect. Value of the start the year less value of the end. So there is no additional, wrong. Value at the start correct, plus value at the end, wrong. Value at the start of the year plus new less value end of the year. So answer is D. D is the right one. Okay. Then 19th question is related to provision for doubtful debts. At the end of year one, trader created provision for doubtful debts at 5% of trade receivable. At the end of the year two, she decided to increase to 6%. The trader provided the following information. So their workings, I already did the working, so you can check. Trade receivable opening. Okay, income state. Here the question, what was the amount of provision for doubtful debts should be included in the income statement for the year 2. Okay, so year 2, how much we have to correct it. Okay, let's see. Step 1, opening how much? 4,800, right? Trade receivable. Opening, then percentage. Yeah, 5%. Calculate. Then you will get the 240. Then closing, this is the closing and year end, 7,500. Here, second year is 6%. So that calculation will be 450. Next, step 2 is very important. New provision minus old. Old is this one, previous one. Okay, 240. New provision is 450. So the difference is 450 minus 240 plus figure, right? You are getting plus figure, that means debit. Okay, remember, if you are getting minus figure, you have to record under income, like provision for doubtful debts decrease. Clear? Now you have to record under expenses. We have to record increase in provision for doubtful debts. Got it? So answer B. Then we are moving to the 20th question. Okay, so inventory valuation, I think. The end of year inventory sold by a sports club shown in the below. So cost price and net realizable value, you know the calculation, right? Whichever the lowest one we have to find. Here cost value and net realizable value, which is the lowest one. Okay, my question, which inventory value is shown in the statement of financial position? Okay, remember the rule, inventory is always valued at the lower cost or net realizable value because of two main accounting principles, that is prudence and matching concept. Okay, based on that, then what is cost of the inventory? It is a calculate actual, it is the actual purchase price plus any additional costs such as the carriage inward incurred in bringing the inventory, so its present position and conditions. Then net realizable value means it is the estimated receipts from the sale of inventory less any cost of completing the goods or cost of selling goods. Okay, whichever is lowest. Here, cost net realizable value, which is the lowest one, 230. Just mark it. 210, 240, which is the lowest, 200 and mark it. And cost football boots 160. This is the lowest one now. So add these three, 230, 210, 160. The answer should be 600. Okay, got it?